Ever wondered how Warren Buffett manages to get unrealistic returns while you're still figuring out your way in investing? And did you wonder about those key principles which Buffett implements in his investing strategy? Then you're at the right place. It's not about how hard you can work, it's about understanding what most people don't. Before we jump towards the 7 rules of investing wisdom, make sure you press the like and subscribe button so that you don't miss anything related to stock market investing and financial freedom. Welcome to 5-Star Finance, the place where you learn how to achieve financial freedom. Warren Buffett is the greatest investor of all time. If you'd invested, let's just say, $2,000 in his company, Berkshire Hathaway, it would have converted into more than $40 million by now. So how has Buffett managed to increase his returns by 3,000 times? In one of his interviews, he mentions those 7 rules which he has always followed to strategize his investing journey. These rules of wisdom can greatly affect how you decide to go about your investing journey. Keep watching because by the end of this video, you will be able to learn all of them. 1. Intelligence and integrity should form the foundation of every value investor. According to Warren Buffett, the 2 most important factors to be mentally strong during investing are intelligence and integrity. Buffett also says that investors behave in a very energetic way. They get all pumped up and excited when they see something happen in the market. Value investors need to be intelligent because they need to analyze the underlying business before making any decisions. The second important trait Buffett focuses on is integrity. Value investors who believe in flat-out lies and all that fabricated stuff will often fall victim to temporary developments without looking at the bigger picture. If you don't look for integrity in investors, you want them lazy and dumb. 2. Pay attention to the facts and not emotions. Most of the time, value investors overlook the returns they're going to get in the long run. They're only looking for instant gratification. That is why they make wrong and absurd decisions. According to Buffett, when a market crashes, there will be a lot of chaos because some investors are afraid of losing money. But the interesting fact over here is that they ignore the importance of this time. If the stock market crashes, that means the prices are low. And when the prices are low, that can be the perfect time to make some quality buys. Investors get very excited and they get overwhelmed by emotions. Benjamin Graham, in his book, The Intelligent Investor, asks people to buy cheap. But these are the things which most people fail to understand and they make wrong decisions. 3. Buy wonderful businesses, not cigar butts. Buffett compares a value investor who looks for short-term, quick profits with the person who walks down the street looking for cigar butts. When you pick up that cigar butt, there is only one puff left in it. So you take that one puff and then you throw it away. Buffett compares this example with investors looking for business due to their temporary hike. These are the same businesses which will cause nothing but flat-out loss in the long run. Investors fail to look at the big picture. Although you can make money with this approach, you cannot make big money, and this is a mistake. It's so much easier to buy wonderful businesses. You should always look for wonderful businesses that come at a fair price, rather than looking into fair businesses with wonderful price tags. 4. Buy only stocks that you understand. You should only expect to make money in things that you understand. And by understanding, Buffett wants you to understand the economics of the business in the future. If you can judge the economical development of the business in the next 10, 20, or even 30 years, that is what proper understanding of a business means. The biggest mistake that some investors make is that they focus too much on a mission and not on commission. Buffett also focuses on going after businesses which lie in your circle of competence. For example, if you have a skill set and requisite experience for companies like Fannie Mae and Freddie Mac, you cannot go for Juicy Fruit and other chewing gum companies. You should always stick with your circle of competence. Only buy stocks which you understand. 5. Seize the opportunity. Missing out on an opportunity can be a costly mistake in your investing journey. When things were within your circle of competence and you were sure enough to make something out of that decision, but for some reason you decided to stay out of it. Don't get caught sucking your thumb. Timely decisions are key for making good and profitable investments. Those mistakes, when you don't seize the opportunity, are the ones which hurt the most. Buffett also gives an example where Berkshire lost more than $5 billion 20 years ago when Fannie Mae was having some troubles. And Buffett could have bought the whole company, but he failed to do so. He could have bought the company for practically nothing. If that company is out of your circle of competence, you don't have any reason to think you're entitled to make money out of that company. But if the company lies in your circle of competence, make sure you don't get caught sucking your thumb. Big opportunities in life have to be seized. You're not going to get 500 great opportunities. 6. Don't sell because of price fluctuations. According to Warren Buffett, your approach should not be to sell stocks unless you get really discouraged by the management decisions and strategy of any business and the business itself. Most of the time, value investors get under the storm when they see fluctuations. They start to sell, and that is a big mistake. Temporary market crashes or price fluctuations are part of the journey, and one cannot ignore them. Market fluctuations can cause the stock prices to fall, and that also means you can lose your money in a short or long time span. This is the time when you need to remain steadfast and resilient. Don't sell because of the price fluctuations. 7. Buy stocks below what they're worth. That's actually what investing is all about. You need to buy a stock below its actual value. Buffett has stressed the need to buy stocks on their intrinsic value. There are many benefits which come along when we buy stocks according to their intrinsic value. It is the value at which we can ignore future fluctuations, and it can be assumed as the true value of a stock. By buying the stocks below what they're worth, you're creating a big safety corner, which will be likely to help you earn profits over time. The formula is simple. If the market value is below that price, go for the buy, as you're more likely to make profits. But if it is above this value, profits are going to be hard to come by. Buy stocks below what they're worth. Remember that you're laying out some cash now just to make some more cash in the future. If you're new to value investing, we made a free ebook about the 6 stock categories, which you can grab your copy in the comment section below. The 6 stock categories ebook is essential to every value investor starting out, so you can analyze stocks the correct way and avoid the most common mistakes beginner investors make. Click the link in the description now and gain unfair advantages over other investors which don't know how to distinguish stocks by their categories when analyzing and investing. Subscribe and turn on notifications so that you don't miss out on anything. Check out this video we handpicked for you, and we'll see you in the next one.